A crisis hits the Oval Office. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, panic hits the Biden administration amid an uncontrollable crisis. And what I want you to understand is this has serious implications for the U.S. economy. But not just that, it also has serious ramifications politically as the president seeks re-election in November. Plus, we have a sponsor for today's show. Megawatt Lithium and Battery is back. You can find them on the CSE under symbol MEGA and on the OTC QB under symbol WALRF. And the reason you want to look them up is because on August 12th, Russian imports of uranium are now banned, and this is going to drive dollars and investments into North American producers like Megawatt. And what we see on the charts as a potential short-term 12% return that could be a whole lot more. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now let's over to CNBC, where we picked today's story up with a headline: is Biden's gasoline sale likely won't have a major impact on summer pump prices. And this is a huge issue, as gasoline is now going to take forefront of news, because you see this as an economic indicator. When consumers can't afford higher gasoline prices, they have no choice but to cut their discretionary spending. But politically, it's also a dangerous game. Higher gas prices could cause voters to say no more. Put barrels in Northeast gasoline supply reserve are equivalent to just 2.65 hours of total U.S. gasoline consumption, and 2 or 3 days in areas where the gas is stored. You might remember this is going to be dumped onto the market. It's not going to be a huge needle mover. Could provide 5 to 10 cents of relief in Northeast, where gasoline market is historically tight, but this is not going to be a huge party at the pump, and this is something the current administration desperately needs. They have to get gas prices down. This will free up dollars for consumers to spend in other parts of the economy, to pay on their debts, and also help maybe change some minds about who people are going to vote for in November. As you'll see, oil prices surged last month as Israel and OPEC member Iran stood on the brink of war, raising concern at the White House that gasoline prices could jump heading into the summer, and that is a huge problem. But gas prices have been trending lower for weeks. Well, not as low as many are hoping, as demand has softened and U.S. oil prices have pulled back 11% from April highs after a broader conflict in the Middle East was averted. And that is, of course, a challenge, because it's not the only issue that's facing gasoline prices. Let's take a look at some of those. But first, if you ever see a headline like this, prohibiting imports of uranium products from Russian Federation, and wonder how you can make money on that, well, stay tuned to the end of the show. Let's check out, of course, Megawatt Lithium and Battery could be a potential game changer for your portfolio. But let's take a look at U.S. regular all formations gas price. This here you can see the prices have come down ever so slightly, but we look back a year ago and they really haven't changed. They dipped early into this year but have steadily risen higher, and this has been squeezing consumers' budgets in a big way. And remember, people often vote with their pocketbook and how they feel when they're going to the poll about their prosperity and their outlook about the economy. And you can see why the current administration is desperate to get prices down at any cost, but they're facing some major headwinds, as you'll see when we look at, of course, U.S. regular all formations gas price, again in blue, against the consumer price index, now both shown on a year-over-year rate of change. One thing that's challenging for consumers is you see periods where gasoline prices are rising on a year-over-year rate of change, and next thing you know, consumer prices are heading down, as we see in red. And what that indicates is the problem we're facing exactly right now, where consumers just don't have a whole lot of money, and higher gas prices are eating into the discretionary side of their budget. That's leading to, of course, slower inflation, but it has other serious implications for the U.S. economy as a whole. And what we can look to is retail sales. Here we see now gas prices against advanced retail sales. Retail sales shown on a year-over-year rate of change, and we can note that as gas gas prices are rising, this in dollars per gallon, what you can see is there are periods where retail sales growth slows, and in some cases even outright contracts, as it did here during the global financial crisis. We can see in 2012 through 2014, the economy indeed did slow down as many feared a double-dip recession. We note in 2018 this happens again, and now we're seeing the effects as well. And of course, I want you to note that we see either a slowdown in the economy or an all-out recession when this happens. And so you can see why, of course, the Biden administration is in crisis here. They need to see gas prices come down, and the problem is they're unlikely to see it unless there is a huge change in demand. As Memorial Day air travel boom highlights thriving jet fuel demand, well, if jet fuel is in demand, that means oil prices are going likely higher, and the trend may offer some relief to oil bulls who are looking for rising consumption to spur a summer rally and break crude out of the tight range it's been mired in as risk in the Middle East fade. But the problem here is the strength in jet fuel contrasts with lackluster outlook for gasoline. And the reason I wanted you to see that prior chart is even though we see lackluster demand, prices remain elevated at the pump, particularly from a year ago, and this is a huge issue. And while U.S. demand for road fuel rose this week, it's still languishing at 2-year seasonal lows. So we have gas prices at 1-year highs, but demand at 2-year lows. Global gasoline demand will fall by an average of 100,000 barrels a day in 2025. Well, it won't matter. The election will be here by then, because here's the problem. As things in Iran are heating up, the Biden strategy to tame gas prices is now in peril as Iran sanctions pressure mounts, and this could, of course, send gas prices even higher. This would be, of course, terrible news for the current administration, who desperately needs gas prices to come down, needs the economy to achieve that soft landing or no landing scenario that the Fed promised us. Well, of course, we know that's unlikely to happen, but any help, well, gives the president a chance at getting reelected. What do you think? Do you think President Biden takes the White House for a second term, or do you think it's something like gas prices or another catalyst? Weigh in the comments. I'd love to know who you think is going to be in office and what you think is going to be the game-changing issue that makes that happen. And with only 6 months to go before the election, at a time when many people start to make their decision about who they're going to vote for, President Joe Biden's strategy to lower gas prices is, well, in jeopardy. The administration's soft approach to sanctions on oil from Iran, Russia, and Venezuela have been key to its efforts to tame fuel costs, but that leniency is becoming politically riskier. Iran's attack on Israel has intensified pressure on Joe Biden to crack down on crude exports from the Islamic Republic. The calculus is getting tricky before an election which rising costs of living, this is the issue, is expected to figure prominently in voting decisions. Remember, a lot of people do vote with their wallets here. How do you vote? Do you vote based on what you think, based on your finances? How do you make your decision? Would love to know. Weigh in the comments, as history has shown that the fortunes of U.S. presidents are closely tied to prices at the pump, even though they have little control over the oil market in the short term. As violence roils the Middle East, U.S. gas prices have surged 18% this year, and the summer driving season hasn't started, suggesting that we're going to see even higher prices into the summer. That's going to eat more into budgets, lead to, of course, less spending on the discretionary side of the economy. And of course, if you can add the math to that, you know what it means for the economy, something that not only the political elites have been pinning their hopes on, but the central bankers as well. I'll show you what's going to unwind next. And if Biden tries to lower gasoline prices by providing sanctions relief, then Republicans will be able to pin it on him in the political theater. And that is this election cycle. This from Kevin Book, Managing Director at Clearview Energy. The risk may be especially acute for Biden because he's taken pains to proclaim lower gas prices as a priority, and for good reason. He needs it. And his high-profile pronouncements on the issue have included accusing oil companies of war profiteering. He's also resorted to emergency measures to increase oil supply, a way of easing prices, which we noted did not work, but did nothing but to drain the strategic petroleum reserves. Now we're draining the Northeast gasoline reserves. And you would think these higher prices in the energy sector might lead to jobs and prosperity, but we found out today in Texas, not the case, as manufacturing activity weakened slightly in May. And you start to understand the issue here, not just from a politically motivated mindset, but from the U.S. economy as a whole, that these higher energy prices are causing serious issues, as you're about to see, as Texas manufacturing activity edged down in May. This according to business executives. The production index, a key measure of state manufacturing, slipped from 4.8 to minus 2.8, meaning is now in contraction. This signals a slight decline in output from April. Not a good trend here, and perceptions of broader business conditions continue to worsen in May as general business activity index moved down 5 points to minus 19.4, and the company outlook index fell 7 points to minus 13.4. So here we see in Texas, which is heavily dependent on their manufacturing sector through energy prices, despite higher prices, is not transmitting into economic prosperity. You see that headed in contraction. Well, here's the risk now, as labor market measures suggested modest employment declines. Now, you remember, everybody's pinning the whole U.S. economy on the labor market, and they tell you it's robust and strong. But now in Texas, which again benefits from higher oil prices, is not benefiting at all now. And slightly shorter work weeks, something we warned was coming. The employment index slipped 5 points to minus 5.3 as 9% of firms noted net hiring, while 14% noted net layoffs. The hours worked index held fairly steady at minus 3.7. So now we see two problems: hours work getting cut and a few more layoffs happening. This is exactly what you see when the economy slows down. So higher oil prices here not working out at all from an economic or political perspective, as upward pressure on prices and wages did continue in May. And that's a challenge. I'll show you why here in a moment, because what's next to go is the labor market. And you can see as we look at, again, U.S. regular all formations gas prices in dollars per gallon against continued unemployment claims, what you see is periods where gas prices are rising, it eats into discretionary spending, which is why I wanted you to see the advanced retail sales data. And when, of course, sales start to slow down, people hit the unemployment line. You can see this effect going back, heading into the dot-com bubble, the global financial crisis. We saw the beginning of it cause a slowdown in labor market heading into the pandemic, and you're clearly seeing that effect now. And if we start to see unemployment claims head higher, well, watch out. That means it's game over for the U.S. economy. And of course, that takes the odds that President Joe Biden will receive a second term by voters somewhere close to zero. And here you can see from Texas, orders are down approximately 10%. This is not good news, and that is about to change. They're saying it was good, but things are now slowing down, and we can tell that this may be a lean summer. Our competitors have been really slow. Our building and construction business remains off. Things seem to be slowing down in our manufacturing sector. We have orders, but jobs not being released. Get this, due to financing holds and uncertainty. So we could talk about how new orders in some places have gone up, but they're not being executed. They get the order in, but they're not being released. That's a challenge. You see further evidence that things in Texas heading the wrong way as business is flat at a relatively low level. Wage inflation continues to be an issue because they have to give wage increases, but that doesn't actually help them out. And here you see transportation equipment manufacturing saying, well, things are nothing short of a mess. And so you look at the U.S. economy here, you look at higher energy prices, and you can see that things on the manufacturing side are starting to go. At a time when many people have pinned the U.S. economy's future on the services sector, we've noted that where manufacturing goes, you see cut hours here, you see layoffs here, these high-paying jobs go away. Their spending on the services side drops too, which is why, of course, now political elites around the world are trying to put the brakes on China, because China's industry threatens an entire global economy now coming out of France saying, look, this is a huge problem. And we have an issue with the economic model in which China is producing more and more cheaper industrial devices because it could be a threat, not only for the EU, not only for the US, but the global world economy. And why is that? Because China, to keep their economy afloat, has turned their factories up. They're producing a bunch of inexpensive goods and trying to dump them on the global economy to save their economy. And what's happening, if that were to go through, you would see job losses all around the world. It would be a temporary boost for China, but bad news for the rest of the world. Now you're seeing everyone starting to put the brakes on this to protect the job market before it goes. And we need to address that issue. This, of course, coming out of France, as leading industrialized nations are coalescing for a tougher and more united challenge to overcapacities in China, which they say could threaten their domestic manufacturing. Again, you lose the labor market, which is indeed coming here in a big way. And next thing you know, you're headed off into recession. This is the early signs, my friends, because when we see a lack of demand, well, that means we need to find ways to increase it, but don't turn to the Fed, because Kashkari says the Fed has no reason to hurry with cutting rates because he can't see a slowdown. Wealth is staring him right in the face as the economy has remained remarkably resilient and the labor market continues to be strong, especially in services, he noted. While nothing should be ruled out in terms of future policy, the Fed would be well advised, he suggested, to wait and see. And that, of course, is dangerous news for the U.S. economy. And, of course, dangerous news, of course, for President Biden, who's hoping to receive a second term by voters. But something you shouldn't wait and see on that is the stock of our sponsor for today's show, Megawatt Lithium and Battery. You can find them on the CSE under symbol MEGA and on the OTCQB under symbol WALRF. Let's take a look at what's going on, because we believe that what's going on in the news is setting up a potential move higher in their stock prices. Could be as much as 12% or even more, as we see, of course, demand shifting to North American uranium producers. And Megawatt reports historical exploration results on the Benedict Mountains uranium property and Labrador's Central Mineral Belt. This is one of the North America's largest uranium deposits, and this is big news for the company. As Megawatt CEO Casey Ford commented, the Benedict Mountains uranium property represents a new level of opportunity for us to advance Megawatt's focus on becoming a domestic clean energy mineral supplier. We're fortunate to be targeting a major prospective mineral jurisdiction that contains a Michelin deposit, and that is one of North America's largest uranium deposits, containing a total mineral resource of 92 million pounds of uranium, which is huge at this time. And Megawatt Metals comments on U.S. ban of Russian uranium imports, a forecast increased uranium production out of Canada. And this, of course, when we see increased production, you're going to see increased attention from investors who are going to realize that this could lead to bigger revenues, bigger profits, and drive money right into their stock, giving you an early advance opportunity here, as imports from Moscow will cease 90 days after the bill is enacted, and that means on August 12th, it's over for Russia. And to help offset imports from Russia, the bill also frees up $2.7 billion that was passed in previous legislation to build America's domestic uranium processing industry. Establishing domestic supply chain solutions for uranium is especially important due to U.S. President Joe Biden having set the goal of America achieving a whopping 100% clean energy by 2035, and reaching that ambitious goal requires significant electricity generation from nuclear reactors, which currently generates more than 50% of America's emissions-free electricity. And toward that end, the U.S. recently announced plans to triple their nuclear power capacity by 2050, which would be a huge opportunity for Megawatt Lithium and Battery and for your brokerage account. Again, find them on the CSE under symbol MEGA, on the OTCQB under symbol WALRF. And again, Casey Ford notes that we understandably in support of America's ban on Russian uranium imports, both as an exploration company and as citizens of the Western nation that values energy independence and geopolitical sovereignty. Now let's take a look at the setup in their stock price here. We're looking at the OTCQB, and what we can note that right here at 12 cents, there's been tremendous support here, and I want you to look at this. You see down here the MACD is in deep and oversold territory, and this is looking to bottom out here. And what we're looking for is a move from the current price up to 12 or up to 14 cents that could realize a potential 12% or more gain. This is in the short term, and as we of course see a shift to North American uranium producers, could send their stock even higher. But as always with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.